Good morning, traders. Today is May 29th, 2022, and boy, do we have an exciting update, special update for you right now. The U.S. real estate market is moved into a massive, violent deconstruction phase. Let's take a look at this chart. First off, the yellow line way up here is the number of price reductions year over year, and you can see in the past basically 3 months, the number of price reductions have gone from negative 0.25, 0.3, meaning nobody was reducing prices at all, to almost 75% of the active listings on the market right now are being reduced in price. This is a massive shift. Sellers are dumping out of the real estate market as quickly as they can at whatever price levels are suitable up here near these current price levels. This blue line represents the current price level year over year for the housing market. Still quite high, still showing 15, 16% year over year rate increases. But what's happening right now, ladies and gentlemen, look at this orange line here. This is your active listing count. We're now at the highest active listing count, excluding this bump here, which was a flood of houses came on the market probably after the foreclosure issue and the Fed rate, before the Fed rate hike. You can see we're at the highest rate level in the last 6 years. Housing inventory is increasing. There's going to be a flood of foreclosures, in my opinion. There's people dumping out of the market right now as much as they can, even though buyers are being restricted out of the market. We're going to see this really change over the next 2 or 3 months. The Fed is probably going to raise interest rates by another half a percentage point, 50 basis points, and this could send the market reeling into a contraction. You can see here the reduced count is now climbing. That's this light blue line, highest level basically in the past 6 years. I expect the number of days on market to climb way back up into this level here, 30, 40%, maybe even higher. And understand that what's really happening right now is people are trying to dump out of the market before the prices collapse. That's what's really happening in the market right now. Anybody that's taking them, buying into houses, they're either in a suitable scenario where they're not concerned about mortgage payments or what's going on in the future or prices, what's going on. But more than likely, as the Fed raises interest rates and buyers are priced out of the market, you're going to see more and more people trying to dump the real estate, thinking that they need to get out of the market while prices are still high, and that's going to cause prices to collapse. We haven't seen prices go negative since 2008, 2009. We could be just a few weeks away from U.S. real estate prices moving into negative territory. Now, let me show you something else that's quite interesting. This is my new custom global asset index. This is on a monthly basis. You can see each of these blocks are 2 years. You can see that we hadn't seen anything really go negative except 2008, 2009, where we bottomed in 2009. And we started to really climb out of it with the Fed's help. You can see again here, when the Fed moved out of the market, we saw assets start to move lower. And this was in 2013. Then we saw assets move lower in 2015, 16, just before the election. Then start to really move higher in 2017, 18, 19. We're now at the lowest level that we've seen, this 2x standard deviation range. We're now at the lowest level of asset price appreciation that we've seen since 2000, actually before 2008. We'd have to go all the way back to probably 2000 maybe to see this. Understand that if we get below these levels, these standard deviation channels here, we could be looking at the largest global asset price devaluation cycle taking place while the Fed is trying to fight inflation. So be aware, even though that we've seen, and I'm going to show you here, even though we've seen consumers, this is the consumer engagement, my custom consumer engagement index. Consumers have pulled away from the market. they're still at an excess level. This was the 2008 collapse. So you saw it pull back more than 50% from a 12 to 10, so roughly 23%. But overall, this was when we saw the global financial crisis take place. We're now seeing a move from 0.19 to 0.15, which again is about 20%. But I do believe that we are likely to see consumers continue to disengage from the economy as inflationary pressures and pricing pressures really wreak havoc on lower end consumers. Lower and middle class consumers are going to get thumped really in this scenario. So understand that we're looking at a very interesting scenario in the markets. Now, what I'll tell you is going to happen in the stock market is this. I'm expecting a 5-wave correction. So you can see here we've got wave 1, wave 2 up to here, roughly wave 3 down to here, wave 4 up to here, and then I'm expecting wave 5 to come down to this area. So understand that wave 5 should bottom around, this is the ES chart, the S&P, around 3490 is where I expect this wave to end. Then I expect, and I'll try to draw this for you, let me shrink this chart up a little bit. Then I expect a sideways exhaustion pattern to take place, possibly moving up and rolling down before falling down to this level here. And again, this would be essentially an A, B, C correction in the market, moving us back down to these mid 2020 levels, the COVID levels, and coincidentally moving us back down to these 2018 highs, which is where I think we're ultimately going to go with this downturn. This move could take many months, literally could take 8, 10, 15 months down here to the downside, which would potentially drive a lot of fear and a lot of contagion event, unwinding Bitcoin and a bunch of other speculative assets. This is almost like the Beanie Baby crash in the sense that 1 week, everything was sky high. 2 weeks, 3 weeks later, everything was falling apart. And 6 months later, Beanie Babies were next to worthless. I'm not saying it's going to be just like that for us, but I'm warning you that we're going to have a little bounce here. This is probably going to be a short-lived bounce where we're at right now. And then we'll resume the selling pressure. Let me spread this out to show you. So we've got this little bounce taking place right now. I think we're only 2 to 4% away from reaching a peak in this area. And then I believe we're going to see more exaggerated selling, another 16, 17% to the downside from roughly where we're at right now. And then eventually we're going to move into this sideways channeling formation, which will be a pause. People will realize, will start to pile in here, start to think that this is the bottom of the market. Maybe the Fed starts to relax a little bit, but inflationary concerns and an unwinding are really starting to take place here. Ultimately, my target level on the S&P is going to be right now 2875 roughly. And that's going to put us right down into this area here. So be aware, we're looking at a very interesting move in the markets, and I believe the Fed's going to have to raise rates at least another 50 basis points to try to stomp down on inflation, which will cause more pricing pressure, eventually possibly easing a little bit before we start to get into a broader downside move. And this could be some sort of a larger contagion event. Don't know what it would look like right now. Possibly debt defaults, credit defaults taking place throughout the world. This puts us around, if my drawing is correct, sometime between, let's call it January, February of 2023 and July of 2023 for this peak area right here. All right, you've been forewarned. Follow my research. Follow me on Twitter. Follow my research on YouTube, and remember, my resources and my trading systems are designed to really help you stay ahead of these market trends.